Hello everyone, and welcome to today's financial report. Let's start with overnight action on Wall Street. The three major indices finished essentially flat. The Nasdaq closed at 26,803, the S&P 500 at 7,799, and the Dow at 53,840, with moves of basically zero. The market is in a quiet phase before a directional decision. But pre-market futures are showing some divergence, with Nasdaq futures up 0.4%, S&P futures slightly higher, and Dow futures down a bit. That could point to tech leading the way today. On individual names, Nvidia slipped a fraction, and Tesla fell 0.45%, mostly on demand concerns. Also worth noting, the Bitcoin spot ETF was down slightly, which matches Bitcoin itself falling 1.5% to around $62,645 over the past 24 hours. Crypto markets are still digesting recent deleveraging pressure. But the ETH to BTC ratio rose 0.51%, suggesting money is being rebalanced between the two major coins. Now let's look at the macro picture. The key signal overnight was that the dollar and safe haven assets strengthened together. The 10-year Treasury yield rose to 4.65%, which is a tight bias and does cap valuation expansion. But interestingly, the VIX fell to 14.53, still in the greedy zone below 15, meaning risk appetite hasn't really contracted. The dollar index broke below 100, sitting at 99.63, down 0.35% over the past 7 days. A weaker dollar is a tailwind for emerging markets. Commodities are sending mixed signals. Oil prices slipped, with WTI down to 81.28 and Brent at 86.96, reflecting softer demand-side pricing. But spot gold jumped 1.48% to $4,436 an ounce, a significant single-day move, suggesting some money is hedging geopolitical and trade risks. When Treasury yields rise and gold rallies at the same time, historically that happens during windows of policy uncertainty mixed with inflation expectations. So we shouldn't simply read this as risk on or risk off. The qualitative takeaway is that we're still in a risk on window globally, but tail risk hedging demand is rising. The invalidation trigger would be the 10-year yield breaking above 4.75%, or the VIX climbing back above 16. If either happens, we should shift to a defensive framework. On the yuan, both onshore and offshore rates are sitting around 6.74, with a spread of only 23 basis points. There's no obvious devaluation expectation. The weak dollar provides support, but escalating trade tensions limit appreciation room. So we're likely to see a range between 6.73 and 6.75 in the near term. A stable yuan is good for foreign investor confidence, and the risk of systematic outflows from northbound capital is low. There were several substantive developments in U.S.-China relations yesterday. The White House released a report accusing over 40 countries of helping circumvent tariffs on Chinese goods through transshipment, involving an estimated $75 billion, and announced plans to develop AI programs for enforcement. On the same day, Trump signed a proclamation imposing tariffs of up to 100% on imported drones. Additionally, the FCC added foreign power inverters and advanced robotics equipment to its covered list, and there are moves to restrict Chinese data center component exports. These reports still need further verification, but the direction is clear. The U.S. is extending tariff barriers from traditional goods into AI infrastructure and advanced manufacturing. Chinese sectors with independent and controllable capabilities will likely command higher valuation tolerance. For today's A-share open, we expect a flat to slightly higher start, based on stable U.S. futures, the yuan holding its ground, and momentum from the Chi-Next board's leadership yesterday. If offshore yuan weakens past 6.75 before the open, or northbound capital sees net outflows exceeding 3 billion yuan in the first 30 minutes, then we should switch to a lower open call. On the index front, the Shanghai Composite should trade in a range today, with the Chi-Next showing relative strength. Yesterday the Shanghai index was barely changed at 3,927, but the Chinex jumped 1.12% to 3,626, and the Shenzhen component rose 0.45%. Growth style clearly dominated. The SSE 50 fell 0.41%, with heavyweights dragging on the Shanghai index. Combined with Nasdaq futures up 0.4% pre-market, today's A-share market will likely see continued structural divergence, with tech growth staying active and the blue chip index remaining subdued. If the Shanghai index breaks below 3,900 on volume after the open, the range-bound call should turn bearish and investors should reduce positions. For the main themes, first is the semiconductor domestic substitution chain. Changxian memory technology surpassing Tencent in market cap was the strongest structural signal yesterday. Combined with planned U.S. expansion of chip equipment export controls in August, potentially affecting around 6 Chinese wafer fabs, external pressure only accelerates the domestic substitution logic. Second is the AI data center supply chain, including optical modules, storage chips, and energy infrastructure. With China's drone export controls countering U.S. restrictions on inverters, upstream materials with independent technology, especially indium phosphide and silicon photonics, will continue to attract capital. On risk avoidance, first are names with excessive gains and institutional selling. AEHR is up 46% on the month with insiders and institutions reducing positions, showing severe valuation stretch. AXTI is up nearly 70% monthly and carries significant pullback risk. Second, high short interest names like VICR should be firmly avoided given liquidity risks under short pressure. Third, pure external demand drone beneficiaries face uncertainty as order verification after tariffs will take time, so chasing is not advisable. Northbound capital is more likely to see net inflows today. The logic chain is a weaker dollar lowering opportunity costs, a stable yuan around 6.74 removing currency concerns, and the Chinex's volume-driven rally creating a wealth effect. But watch this signal. If the Shanghai index shows widening divergence between the white and yellow lines on the intraday chart, and CSI 300 ETFs see volume without price movement, be alert to foreign capital selling into strength. Confirm with real-time northbound flow data. On individual stock opportunities, X-Energy shows a range-bound bias to strength with a 62% probability over the next 1 to 3 trading days. The trigger is the AI data center power demand narrative continuing to build, bringing small modular nuclear reactors into focus as a clean and stable power solution. The invalidation condition is breaking below the day's low or the market turning weak. Position discipline suggests observation only, no chasing, waiting for a pullback to the 5-day moving average. SanDisk shows a 55% probability of range-bound strength, with the NAND flash recovery story awaiting volume confirmation. Also observation only. For existing positions, indium phosphide substrate names are relatively resilient at 58% probability, continue holding. Data center high-voltage transformer names are also resilient at 58%, with the monthly pullback viewed as healthy. Silicon photonics names at 58% probability, continue holding with room for catch-up gains. COHR suggests partial profit taking while holding the rest, watching institutional selling. AEHR suggests partial profit taking, and exit if it breaks recent support on volume. For risk avoidance, VICR with high short interest should be firmly avoided. AXTI with high-level pullback risk should be watched from the sidelines. There are no high-confidence weak market candidates for reverse long positions today, so staying in cash is better than forcing trades. Here's the core judgment for today. The dollar breaking below 100 combined with Chinex leadership means a share tech growth continues to outperform, but rising treasury yields cap index upside, leading to a range-bound but firm tone. Our probability assessment is 35% up, 45% range-bound, and 20% down. That's all for today's market analysis. Thank you for watching, and we'll see you next time.